Norbert Lu, one of the most secret investors on Wall Street, recently started to buy PayPal shares. And straight away, he made it 15.6% of his US stock portfolio. But why is this incredible investor buying a stock that is down 78% from its peak and just this year went down by almost 22%? Is he catching a falling knife, or is he making one of the best investments of his career? So let's analyze this company to answer this question. Let's start by going to our investment analysis library, which you can get access to by becoming a patron of this channel. And let's choose PayPal. And let's start with past results. So we can see that in the last 5 years, we would lose 65% of our investment. But if we look at the 10-year total returns, we would be up by 105%, so we would double our money. That is okay, but nothing incredible. I mean, especially if we look at the last 5 years. That is the reason I was talking about the falling knife. So the past results score overall is just 1. Okay, now let's go to investors. So we can see that individual insiders own only 0.2% of this company, but we have 8 super investors that bought shares of PayPal. And when it comes to insiders, they are mainly selling in recent months. Last purchase from an individual insider was in February 2023, so not a lot of conviction from insiders. Now, when it comes to super investors, we have here people like Norbert Lu, David Rolfe, David Katz, and actually 5 of those 8 super investors that own shares of PayPal were buying PayPal last quarter. So the overall score for investors is just 1.5. Now let's check the financial health of PayPal. So we can see it has a return on invested capital of 12.2% in the last 10 years. Net profit margin is 14.4%, so that is all really nice. But what's really interesting is share buyback. It is minus 20.2%, so that is absolutely great. If you invested in this company 10 years ago, you didn't actually have to buy any more shares to own a bigger percentage of this company. Now, if we look at years to pay debt, it is 1.9. So that is nice. We want it to be under 2 years, and it is just under this threshold. So the overall financial health score is 2.3. That is very, very nice. And also, if we look at some history graphs, we can see that the net debt actually is going up. So that is not good, because we want to see a situation in which a company has more cash than it has debt. It is not the case when it comes to PayPal right now. In 2019, 18, and before that, it was like that. So that was much healthier, much safer for investors. But here we see shares outstanding, and they are going down all the time. So that is this minus 20.2% that we were talking about. Okay, now let's look at the growth of PayPal. So the revenue growth is 14.8%. That is nice. We want to see it over 10%. The same story, 14.6% for free cash flow growth, and earnings per share growth is 16.9%. So basically, with all the metrics, the growth is very nice and very similar. Earnings per share is a bit higher because they are buying back shares. So the overall growth score is 2.0. That is very, very nice. Now, when we look at the history graphs, we see that the revenue is going up very nicely, steadily. And when it comes to earnings per share, well, it is not as steady. We see that there are some serious bumps. Of course, the spike was caused by COVID. Then in 2022, it went down dramatically, but now it is up and it's steadily going up from 2023 to 2024. So that is nice. Okay, and let's take a look at the dividends. So we can see that the dividend yield is 0 and that PayPal is not paying any dividends. But we have a very nice growth, so that balances everything out. Okay, now it's time for the valuation. We will use a discounted cash flow analysis and we will create 3 scenarios: low, medium, and a high one. So the low scenario is showing a story in which PayPal will grow slower than it did before. Medium is very similar to the growth we saw last decade, and also it is very similar to the predicted growth of the entire industry, which is around 13.6%. Now, the high scenario shows a story in which we believe that PayPal will accelerate its growth. Not by much, but still it will accelerate. So, as you can see, it is all in the green. We have intrinsic value from $129 in the low scenario to $181 in the high one. But if we apply a 30% margin of safety, of course, you can apply any margin that makes you feel comfortable, but that is the one I like to use. We get $90 in the low scenario, $113 in the medium scenario, and $127 in the high scenario. Now, the current price is $68. So, overall, the average intrinsic value with the margin of safety for PayPal is $110. That is well above our current price. So, the current upside is 61.1%. That is very nice. So the current valuation score is 3.0. Now let's take a look at the overview of this company. So we can see that past results, that is just one point that is rather disappointing. Investors score 1.5, not that good, but okay. Financial health 2.3. Very nice. Growth score 2.0, also a nice growth. Now we don't get any points for dividends because they are not paying any dividends. And the current valuation 3.0, so really, really nice price. So the overall score is 1.6, and it is not that high because we lose some points here with the dividends and with past results. Now, PayPal is definitely going through a challenging period with increased competition and changing consumer behavior. But the fundamentals remain strong. The company has excellent financial health with nice growth and a very interesting price. The big question is whether PayPal can reinvent itself for the next phase of digital payments. That will determine if this is a value trap or a great opportunity. If you enjoyed this analysis, then definitely watch my video on American Express and Warren Buffett's unshaken belief in this company. Thanks for watching and see you in the next one.